Hello and welcome to Capital Markets Live. I am Michael Drain, Acting Executive Vice President at Ginnie Mae. Today I'm joined by Satish Mansakani, Head of Agency MBS Research at Bank of America Securities. Satish is a top-ranked institutional investor analyst for 15 years, awarded this perennially for offering investors insights from new data, interpretive analytics, and unique access to mortgage lenders, traders, and policymakers. Welcome, Satish.
Thank you, Michael. Thank you for having me on your podcast today, and I appreciate the invitation.
Let's begin with your outlook for spreads based on your macro framework and potential near-term reserve reaction.
So if you look at slide 2, just to kick off, we are currently underweight the mortgage basis. We sit at a critical juncture in the markets. The mortgage basis is largely beholden to Fed rhetoric on FATE, flexible average inflation targeting. With a recent fall in market expectations for inflation, it's widened the current coupon spread. Secular stagnation, on the other hand, is leading to suppressed real rates, which is keeping Ginnie to Fannie swaps under pressure, likely to remain the case until bank lending resumes. Locally, mortgage rates have room to drop, catching up to the Treasury rally headed towards Jan's historic lows. We see on the bottom right chart here that the derivative sectors pricing growing prepayment uncertainty, and the call-protected sectors, namely specified, you see on the bottom left chart, priced to negative spreads. This all creates a difficult backdrop while the Fed is talking about tapering. China, for instance, has eased its policy stance while the Delta variant risks in the U.S. are growing. Does walking back its taper talk for the Fed with Powell is a key question on hand.
Can you share with us your thoughts on the Ginnie Mae net supply and demand amongst the Federal Reserve, banks, money managers, and investors?
So turning to slide 3, Michael, I like to look at the conventional sector. We show the supply and demand at the bottom table as akin to the growth play, and Ginnie Mae's the supply and demand dynamics shown on the top table here as akin to the value play, borrowing from parlance in the equity markets. As you can see here on the top table, the sole buyer of Ginnie Mae assets has been the Fed. The absence of two large entities, domestic banks and overseas investors that historically have paid up for the sovereign guarantee on Ginnie Mae that we estimated about 0.5 point, has resulted in Ginnie's trading closer to or below conventional MBS prices. We see this pricing regime continuing, at least until domestic banks see a turn higher in their loan books, which would then spur demand for level 1 high-quality liquid assets that Ginnie Mae's are. The challenge here is a secular stagnation backdrop I spoke about just before. If we do see a rebound in bank lending, this could coincide with a turn in higher real rates, and at the back end of which we can see some potential for overseas investors, notably Japanese buyers, to step back in. Until then, we see private investors continuing to favor conventional over Ginnie Mae MBS.
Satish, what is your analysis of forbearance exits and extension rates showing?
Sure. Let's turn to slide 4 for some pictures on this. The summer is key for forbearance exits, with the majority of forborne loans scheduled to exit their plans. And you can see that on the top chart there, the period over the next 3 months are critical, July through September. And in terms of the exits, to date, we see 25% of borrowers having extended their plans, an option they have for up to 18 months. But the majority, 75%, have exited, as you can see on that bottom table.
What are your expectations about the aggregate amount of loans to be bought out between banks and non-banks?
So the banks have been very efficient at conducting buyouts while the non-banks are working through this. The drivers for the banks is the funding trade, as it is cheaper to fund by having these assets on their balance sheets, while the non-banks have to cherry pick loans based on forming an outlook for borrower performance to be able to secure funding via market sources until they can securitize these assets. Given this inherent risk, we see month-to-month changes on non-bank buyouts. And slide 5 shows a picture as of the data that we have available showing the efficiency with which the buyouts are conducted for the banks on the top part, and then the divergence that we see between the non-banks in their buyouts at the bottom.
And what do the individual servicer level data points show for buyout rates in non-banks?
Here, we can turn to slide 6 for a little closer look. It changes on a monthly basis for the rate for each non-bank entity. However, the outstanding securities that tend to be impacted are largely the higher coupons, 3s and higher. This is shown on the top panel on slide 6, and particularly of the relatively moderately seasoned vintages, which is production from 2018 and 19. In the last reports that we had available, the top panel, the super premium 4.5 and 5 coupons faced buyouts. And if we look at where those buyouts came from in the month of May, they were largely driven by a handful of lenders, 3 particularly that we spotted up: PennyMac, Nation Star, and Quicken.
What are you seeing for non-bank modified issuance?
We see the modification of loans gaining further attention, especially now that Ginnie Mae has launched a pooling program to accommodate these. I don't have a slide for this, so it's still TBD in terms of what the data shows us. The rationale for modifications is that today's low interest rates can be appealing to borrowers who can prefer this over a partial claim. There is a hesitance from borrowers to grow their debt load through a partial claim, which adds the forborne amounts to the back end of the loan. The next few months are also critical to see an uptake into modifications, especially by certain non-banks where buyout rates have remained low. And rather than them taking the risk to fund the buyouts to secure the funding, hold it onto their books for 6 months of borrower payments before they can securitize into the existing custom pools, a modification can be far more appealing, aligning incentives for lenders and borrowers and providing the securitization channel for some of those executions over the next few months.
What can you tell us about the non-bank buyouts remaining on balance sheets and the percentage that could end up in RG pools?
We monitor this on a monthly basis for the non-bank buyouts, how much is securitized through the Ginnie Mae RG pool ticker, how much remains on balance sheet. Again, just the numbers. To date, we have seen about $9.2 billion securitized through June 2021 by both banks and non-banks in the RG program. Non-banks issued $3.6 billion RG pools through June out of the $25 billion in non-bank buyouts that potentially meet the RG pool seasoning requirement, which is basically loans that were bought out between July and December of 2020 and remained on balance sheet and then qualified for the repooling. Another $21.4 billion of bought out loans still remains on non-bank balance sheets, and some, if not all, could eventually be issued through the RG pooling.
Turning to purchase loans, what have the purchase issuance characteristics been for Ginnie Mae 30-year?
Yeah, we can turn to slide 7 for this. A few charts here. Just to summarize them, the Ginnie Mae purchase funding continues to be dominated by non-banks, stands at almost 90% of total issuance. Through the pandemic, we've seen loan sizes rising, but also seen FICO scores rising with that, especially at the height of the pandemic last summer when credit quality was subject due to rising unemployment.
And what have the refinance issuance characteristics been for Ginnie Mae 30 years?
Refinances are also primarily funded by non-banks. Here we see that loan sizes have remained stable to declining through the pandemic, while FICO scores have risen moderately across FHA and VA channels. And I think this really speaks to some of the household deleveraging trends that have been ongoing with all the stimulus checks.
You say excess industry mortgage origination capacity and rising home prices have affected the market for Ginnies.
So let's turn to slide 9 for some interesting trends on industry capacity. As you see on the top chart, we see the industry has built capacity at the fastest pace in 20 years and has been adding capacity even into higher rates. And this chart shows just how capacity is correlated to processing of all the loans that lenders see and broadly explains a lot of what we eventually in the markets estimate and capture on prepayment speeds. Capacity deployment is also very efficient and effective in that stemming from a lot of the lenders having gone public, raised capital this year, built capacity. And that's leading to rising prepayments on Ginnie tools, which you see in the bottom chart there, and where slowdowns into higher rates have been lower than on conventionals, especially as these weaker credit borrowers, they require additional lender capacity for due diligence, for underwriting, and they're the beneficiary of new capacities being dedicated to them. You're seeing not only more capacity, but more efficiency on how that capacity is being dedicated to capture volumes.
Well, it looks as if that is all the time we have for today. Satish, thank you so much for your time and for sharing your insights on the Ginnie Mae MBS market.
Thank you, Michael, and thank you to the entire team at Ginnie Mae for hosting me on this podcast.
That was Satish Mansakani of Bank of America Securities. If you enjoyed this podcast, be sure to subscribe to future episodes of Capital Markets Live on YouTube. If you have any comments or questions about today's episode or other topics, please send us an email at ocmglobalinvestorinquiries@hud.gov. Again, thanks for listening, and until next time, stay healthy.